Well, good afternoon, everyone. Welcome to this timely session on financial inclusion through technology, the regulator perspective. My name is John Palmer. I'm a 20-year veteran of the Toronto Centre and until recently the chair, and I'm your moderator this afternoon. I wish to thank the European Microfinance Platform for inviting us to organize this discussion. We're all committed to financial inclusion, which we see as an important vehicle for alleviating poverty. Voice, I don't think it matters.
No.
Okay? All right. Did everyone hear what I just said, or do I need to repeat it? I have a feeling you all heard. So we're all committed to financial inclusion, which we see as an important vehicle for alleviating poverty and empowering women and girls throughout the developing world. As we've been discussing at this conference, there are exciting developments taking place as technology helps to make financial inclusion a reality more quickly than we might have imagined just a few years ago. However, Fintech and related developments create challenges and even dangers for customers and intermediaries, and just possibly some systemic risks. These require the oversight and involvement of regulators and other national authorities. Regulators face a delicate balancing act, helping to protect customers from abuse, intermediaries from undue losses, and financial systems from destabilization, while at the same time trying not to suppress responsible innovation, and indeed even fostering that innovation that is needed to enhance financial inclusion. As many of you know, this challenge for regulators has been part of the work of the Toronto Centre.
Maria Mansink is awaited in the room N.
All right, it's good to know. This challenge for regulators has been part of the work of the Toronto Centre for many years. We're committed to the relief of poverty and the empowerment of women and girls through financial inclusion, and we've been working with the regulatory community to help regulators understand how to carry out the delicate balancing act that I referred to. Every year, Toronto Centre offers several training programs on financial inclusion, including microfinance, microinsurance, consumer protection, and digital financial inclusion to help regulators be part of the solution rather than part of the problem. We've assembled a terrific panel to help us explore the regulatory challenges. I'll introduce them very briefly now in alphabetical order, but longer CVs of the speakers are available as handout material, and I think you've all received that. First is Mrs. Socorro Hazen Segara, the Superintendent of Banking, Insurance, and Private Pension Fund Administrators of Peru. She's had a very distinguished career, including service at the Central Reserve Bank of Peru and the International Monetary Fund, as well as an earlier stint as superintendent. Next is Mr. Giazuddin Mohammed, a policy manager, digital financial services with the Alliance for Financial Inclusion. Giaz has worked on various projects with regulators and other government authorities, banks, mobile network operators, and microfinance institutions in Asia, Africa, and the Middle East. Giaz is based in Kuala Lumpur. Third is Matthew Susurian, a financial sector analyst with CGAP, an organization with which the Toronto Centre has worked closely for a number of years. Matthew has also worked with the New York City Department of Consumer Affairs, the International Financial Corporation, and the Federal Reserve Bank of San Francisco. Last but not least is Dr. Dirk Zacche. With a name starting with a Z, Dirk, you're almost always last when you're introduced, aren't you? He holds the ADA Chair for Financial Law at the University of Luxembourg since March 2016. Professor Zacche has served as an advisor to the European Commission, the European Parliament, the European Securities and Markets Authority, the German Ministry of Justice, the German Ministry of Finance, and the Financial Stability Board. He has also worked in the private sector as a lawyer. We hope to keep today's discussion informal and interactive. We will dispense with formal presentations. No PowerPoint. Instead, I will ask 3 rounds of questions to each of the panelists. Then we should have time for a robust question and answer session before we close on or about 5:20 this afternoon. So now let me join the panelists and begin the discussion. So I'm going to direct my first question to Giaz at the far end of the table. Giaz, in a recent, is this not working? Aha. Is that better? Good. Giaz, in a recent AFI paper that you co-authored, there was an important proposal for a strategic framework that would support digital financial transformation. Please tell us more about that framework and its 4 pillars.
Thanks, John. Good afternoon, everyone. I'm Giaz, Policy Manager for Digital Financial Services at Alliance for Financial Inclusion. Briefly, Alliance for Financial Inclusion is like a network of regulators working on financial inclusion policies. So we are a network of more than 90 countries from across the globe. Before responding to John, I'd like to thank the organizers, European Microfinance Platform, for inviting AFI to participate in this prestigious event. John talked about a framework for digital financial transformation, which AFI recently launched, and we have a few copies of the report at the table on the back, so you may want to pick it up on your way back. So this framework talks about leveraging infrastructure as well as enabling policies towards using digital finance ecosystem to advance financial inclusion. There is a Luxembourg connection to this framework. Professor Dirk, sitting next to me, helped us conceptualizing this framework, and we are thankful to Professor Dirk and his colleagues from Hong Kong and Australia for helping us with this. So this framework talks about 4 key pillars. So as a ecosystem, there are 4 key pillars which we believe are essential for leveraging digital finance to advance financial inclusion. The first pillar is on digital ID and eKYC. The second is on open and electronic payment systems. Third is on account access and digital payments strategy. And fourth is on value-added services strategy. So once you open an account, you create value-added services. So there are 4 pillars that this framework talks about, and I'll take you through these pillars briefly. But the foundational basis for these 4 pillars is an enabling regulatory environment. So we have 4 pillars, and then as a foundation, we have an enabling regulatory ecosystem that has 3 essential aspects: consumer protection, data privacy, and cybersecurity. And John, with your kind permission, I would like to spend the next 2 minutes briefly explaining about these pillars, actually. First is on digital identity. More than 1 billion people across the globe don't have an identity. So they are physically present, but legally absent. And this means their entry into formal financial systems is also restricted. And the global Fintech, which came out in April 2018, says that 19% of the people who did not have an account cited the reason of lack of documentation for not opening an account. So 1/5 of the people who don't have an account cite not having proper documentation as a reason, actually, so which is very significant. So digital ID to provide a base proof of identity and also to facilitate entry into formal financial systems, we believe is really very essential. Second is on open electronic payment systems. Payment systems are like the arteries of the financial sector. They are the route through which consumers can have access to various payments as well as financial services, actually. So we've seen various types of payment services infrastructure, private sector-led payment services. So we've seen this in the whole of East Africa, Sub-Saharan Africa. So mobile money is very prevalent in order to move money from one end to the other through the digital rails. Apart from that, we've also seen regulator or government-led payment systems coming in. So Indian example of having a national payments gateway to enable retail payments is also worth noting here. So to complement the thought on open electronic payments, what is very important to note is the importance of interoperability. So being able to talk from one provider to the other is really very important to create that network effect and increase the usage of payments and financial services. Third is on creating an account access strategy. So, and this is through digitization of bulk payments. So if you look at government, for example, government is typically the largest employer in a country. And we've seen, especially in emerging market economies, the payments are often not in digital form. So as a first door towards digitization, looking at digitization of bulk payments in terms of cash transfers, subsidies, could be a good way of advancing financial inclusion. And finally, the fourth pillar is on creating value-added services. So the first three pillars talk about access. We have opened more than 2.1 billion accounts, provided access to 2.1 billion people in the last 10 years, but 1.7 billion are still unbanked and underserved. So we have an access strategy to reach out to them. So once you reach out to them, how do you ensure the stickiness? How do you ensure that the account is used consistently? That is where the value-added services come in. So once you open a transaction account for the user, you provide further pipes or links to connect to a financial services provider, an insurance provider, to enable additional use cases. This could be in the form of insurance, this could be in the form of savings, credit, so on and so forth. So these are the four pillars that I wanted to highlight, but this is not prescriptive in nature. We don't tell that, okay, you have these four pillars and here you go. It's a very flexible living approach, and it's very contextual to a geography. If you already have a national identity, for example, the things to look for you would be digitizing that national identity as part of that framework. If you already have a digital identity framework, linking it to formal financial services is something that you should look at. So, but we believe in its entirety, these four pillars could use digital financial services to the maximum extent to advance financial inclusion. I'll talk about the consumer protection, data privacy, and cybersecurity angle in the next rounds, but with all things digital, if you don't have these three frameworks in place, there's a good case for consumers to be exploited and fleeced. With that, I'll pause, John, and I'll hand over the mic to you. Thank you.
Yes, thank you very much. I think those four pillars give us something to build on this afternoon. Now I'm going to turn to Matthew. Matthew, when you and I talked earlier about the most important developments in the fintech space in terms of the potential impact on financial inclusion, you mentioned that in your view, the most important fintech developments are those that can cut costs of delivering financial services. Can you talk to us more about some of those developments? and how they make it possible to serve a broader range of customers, including those who are not served at present?
Yes, thank you very much, John. So yes, on the point of fintech developments, one broad point that I'd like to start out with is to distinguish between the different levels of innovation that we see, because often when we talk about fintech and the changes that fintech is bringing, we associate that with new players or new challengers coming in. But in fact, it's deeper than that, because what we also see is not only these new entrants and challenger banks and neobanks that on their own are going to potentially provide valuable services at a low cost, and through that could increase competition and kind of push incumbent banks to change their product offerings as well. But we also see that fintech developments are being used directly by incumbents and by mainstream financial institutions as well as MFIs in ways that are enhancing their ability to serve population segments that have been traditionally excluded. And then the third piece is around financial technology that is being used both by providers and by regulators and supervisors and bringing down costs. So RegTech, which is a general term that can refer to technology solutions to help providers comply with regulations and help them make the supervision and inspection process easier. We think that there's a lot of potential there as well. So yes, on the question of lowering costs, I think one of the areas that we think is very exciting is about how you can bring down costs that are related to customer acquisition, because by doing that, if you think about what it costs a provider to acquire new customers, one of the challenges for them, which was mentioned already, is around their customer due diligence requirements, which are related to AML/CFT regulations. And so we're seeing exciting developments in this space, not only that lower costs, but they can also lower risks for providers, which makes it more feasible for them to then serve customers that they might have previously excluded. And so one example that is enabled by technology is remote identification of customers, which overcomes barriers to geography. So one example is World Remit, which allows customers to upload their identification documents rather than requiring them to travel to an agent or to a brick-and-mortar location with those documents in hand. At the same time, there are growing solutions around collaborative approaches to customer due diligence, which is sometimes called KYC Utilities, which is when multiple providers pool that function or outsource it together to a specialized entity that is able to carry that out on behalf of the provider. And sometimes that's in a more commercial setting, and sometimes it's more related to the eKYC developments that we're also seeing, which can often be something that's done in partnership with the government who carries that responsibility. Other developments that we see are related to credit. So, of course, we've heard a lot about alternative credit scoring. For example, using airtime usage data, which allows you to score clients who don't have a credit history or who lack a credit profile. And, of course, we would be the first to say that this approach does not come without its challenges, and it shouldn't be used as a substitute for strong underwriting standards, and we see that there are concerns around that. But we do think that if it can be done in a responsible way, then there is great potential to help clients who are very thin file or zero file develop a credit profile that could then open doors in the longer term to longer term, cheaper sources of capital. And some other exciting technological developments that we're watching, and I'll just go through a few examples that we see are bringing down the costs, the operational costs of running core banking systems. So one example is through cloud computing, and there's an example of the Cantial Bank in the Philippines. There's also, we see costs decreasing for remittances using technology, and a provider that's an exciting one to watch is BitPesa in Kenya. Then Graham Wright spoke about this morning, an area of personalization of products that can be done more easily when products are delivered over a digital channel. So that could be around creating tailor-made financial products, for example, allowing the customer to choose the payback period, the tenor of a loan, et cetera, and personalizing that based on what makes sense for them and what they'll be most able to repay. And then another angle that we think is interesting is integrating advisory services directly into the distribution and delivery of financial products, which is something that has been around for a long time in the MFI world around providing financial education, financial literacy, financial capability training with products. But we also think that digitization allows for new opportunities to do that, and perhaps providing just-in-time advice, which a lot of research shows that has a great potential in helping people make decisions that make sense for them. And then finally, I'll just close with the other plug for RegTech and also SupTech, which can help the superintendents to do their work. But I don't want to steal anyone's thunder.
Matthew, thank you. Dirk, when we discussed the most important developments in the fintech space in terms of potential impact on financial inclusion, you stressed the importance of putting in place the necessary infrastructure for financial inclusion, and you focused on e-identity, which in your view is really at the core of the matter. Can you expand on this, including the type of e-identity system that might be most effective in developing countries, including the role of the central bank or other national agencies in running or supporting such a system?
Thanks, John. Yes, in fact, GS laid out this type of four-pillar approach, which could be the most effective strategy to further financial inclusion. And the basis of it all is identity. If you do not exist legally, you do not exist in the banking system. So how do we approach it? We have about 1.2 billion people who are not yet banked. That's about a third of the adult population in the world. And most of these people, while not having a bank account, they also don't have any type of official ID. Let me refer to this type of official ID as base ID. So that is a kind of identification means that is provided by a centralized ledger, a state bureaucracy like a passport, an identity card, a social security number that's centralized, something that puts you in an official register that can be used, for instance, by sending government payments or subsidies or whatever type of services. So the problem with these type of people is that they do not have a base ID for economic reasons. When you live in the countryside, far away from a state bureaucracy that could provide you with a base ID, it is just too costly to go to maybe the capital of the country to apply for such a base ID. When you have hardly the means to survive, the least you're concerned with is getting a passport because you don't travel so often out of your immediate environment. And when you have never achieved a kind of base ID like that, the lack of base ID is a major barrier to financial inclusion. So what we pondered about in this system is how do we approach this very, very mixed circle. You have on the one hand no base ID, but a base ID is a precondition for any type of bank account. Let me refer to the identification there as business ID, okay? Because when, for instance, you have a PIN-TAN combination, that is a type of identification device that rests on the base ID. So right now, most policy approaches start by strengthening the base ID registers. That means you have to invest a lot into passports. But how do you do that when those people that need the passport simply don't come to you? So the approaches that we have so far start with screening the hospitals. But still there's a significant fraction of the world's population that is not born in hospitals. Now that's just born on the countryside, like humankind was born for the better part of history. Yeah? And so there are always deficiencies in that system. That means we lack a fully inclusive approach. So maybe the idea is to move away from the base ID approach and just start outright with the business ID. And here's why. when you sit in this room, by the very fact that you sit here, that you have a voice, that you have eyes, that you have a fingerprint, that you have a biometric feature in your eyes that we could use, your DNA, there's a lot of things that are so individual about you that are a much better identification means than using a passport. A passport is a reflection of yourself, but this is not yourself. But when you really look at your biometric data, this is something that is there to stay. Your DNA is not going to change, at least not significantly. So that if we would rely on this type of biometric identification means, rather than a kind of state-provided base ID, we could immediately bring in people that need a bank account into the financial system. So how can this work in practice? Well, rather than requiring the passport, you just go there with your biometric features, scan those biometric features when you open a bank account, and then you're first stored by the bank. The bank sends these biometric features to a centralized institution, which kind of saves them, and thereby makes it sure that you are registered there. Maybe you can give a fake name, but your DNA, your biometrics are still unique. Yeah? And therefore, we achieve one step by step that the centralized database is capturing these type of individuals in the system, and at the same time, they can immediately start business. And I think this is an approach that we should follow in the future. So what are the arguments against it? The most aired argument is AML-CTF. Well, that's odd. People in the Western countries can start a bank account with 9,999 euro, which is basically the value of some villages in certain parts of the world, without anyone asking where the money is coming from. The type of transactions we're talking about is usually below 25 US dollars, and even that are fairly large transactions, we have to say. Yeah? So we can bring in most of the people that are yet excluded by simply giving up a kind of crazy base identity focus and focus immediately on the features that we all carry around. And then the legal identity and the real identity are matched, and we have the people in the financial system. And we are much faster in developing a base ID system in an environment where we have no other means of registration in the respective countries. And I think that's a fairly good approach to bring the 1.2 billion people, maybe 900 million of them, faster in the financial system than we can do simply by focusing on the base ID system.
Dirk, are there any examples of this actually in operation in the developing world?
Well, we have certain experiments, in particular with migrant workers. When they get into countries of Europe, we have to identify them somehow. Mm-hmm. And there's usually a strong resistance to provide the base ID. Either it is lost, or you don't want to provide it because you know when you hand it out, you're shipped back. And for that reason, these institutions typically take the kind of biometric features in order to identify you, and then maybe the thumbprint or something else is what is really being taken to give you a new identity. And of course, the same mechanics can be used then, of course, also for opening bank accounts and whatever, because based on these biometric features, you become a new character in a way.
That is really interesting, and I think has tremendous potential. Socorro. I know from our conversation that a lot is happening in the Fintech space in Peru. Please tell us about the most important Fintech developments in the Peruvian microfinance sector.
Okay.
Voilà.
Okay, thanks, John. First of all, a lot is happening in Peru in the Fintech sector, but I must admit that at this point of time, the volumes are still small to make a big difference. It will take time, and it will take development of regulation, infrastructure, and ideas to apply all this new technology into financial institutions. Up to now, there are 47 fintechs operating in Peru. There are various types of business models and various types of interactions and relationships with the financial system. Some of them are competitors, some of them are collaborators, service providers. So there's very different types of fintechs that we have. I just want to concentrate on 3 big types that are useful and that have been already operating for a few years. The first type is those that have to do with analysis type platforms, and such as comparison platforms or auction platforms or credit scoring platforms. So comparison platforms, for instance, there is one called Solvent that basically allows financial institutions, they collaborate with financial institutions, and it allows financial institutions to grant loans online. And there are more than 30 financial institutions that are hooked into this system. In terms of the proportion of the loans granted by financial institutions through this vehicle, it's still small. But what it allows is also the customer to make financial institutions compete for the customer loan. And so it allows the customer to look at different prices for his own profile and his own project. So that is a very interesting system. It has already been working for a few years. Another type is the auction platform for deposits. And it operates in a similar way as the previous one. It's called Tasa Top. What basically it does is a person says, well, I have $10,000 or 10,000 soles, which is the Peruvian currency, and I want to get the best, and I want a time deposit of a year or 3 months, and I want to get the best rate for my money. And so financial institutions compete in that platform for the deposit. And of course, there is no obligation for the depositor to put the money at the end, because the depositor has to assess whether the risk of the institution granting or offering the highest interest rate is acceptable for him. So there is an auction. The depositor says, well, you have, this institution offers you the best rate. These are the other 2 or 3, and you decide which one to choose. You can choose the highest rate, the second, the third one, depending on your risk. And the other one is credit scoring, that they basically use either psychometric models or big data to analyze the data of customers and provide a scoring. There are different ways of doing it. They operate with financial institutions providing services to the financial institution. The financial institutions buys the services and gets a score for the potential debtor or borrower. So those are the first type of fintechs that we have. They are basically analysis type platforms or information providers or auction platforms. The second one, which interacts with the financial system more as a competitor, is the crowdfunding type startups. Basically, they pick up your funds and they grant loans. And these ones are kind of small, still very small. They operate mostly in the urban environment with young type customers. So it will take a while for crowdfunding type platforms to pick up. And they, right at this point in time, they operate mostly with the already banked, because they take information from credit bureaus that are in operation as part of their assessment of the borrowers. So they are not a platform for financial inclusion yet. I'm not saying that they cannot be, but at this point in time, they are basically operating with the people that are already banked. And then the third type is e-money or different types of payment services. There is a a system that was launched in early 2016. We call it BIM, B-I-M. It's an interoperable electronic wallet. And we sort of call it the Peruvian model, because what is special about it is, first, it's fully interoperable, and second, it was started by financial institutions. About 30 financial institutions in Peru are shareholders of BIM, including 19 microfinance institutions. So BIM has started, it has the potential, and it operates both on smartphones, but also on the traditional type little phones that are used in rural areas, faraway places. So far, BIM has about 400,000 users. And it's growing at 30% per month. Since, I mean, of course, it starts with a very low number of users, so the potential for growth at this early stage is huge. And the challenge that BIM has is to convince the users that it is worth using it. So because right now there are a lot of people that have been signed up for BIM, but very few of them use it regularly. What can you do with BIM? You can pay services like phone, or you can go to a small store and pay for your food, or you can transfer money. For instance, the government uses BIM as one of the options to transfer money for the poor. I mean, it's not mandatory that the poor has a BIM account, but it's one of the options that you can use to receive the money transfer for government programs. So it is growing, and the growth will depend on the how many businesses use it, how many small store owners use it. Because if the customers see that they cannot use BIM to pay many services, then they will not use it too much. So that is a big challenge, and it's too early to say, but we are pretty optimistic about it. So those are the three types of businesses that are being used. I mean, there are many others like currency exchange and other services. And then the last idea that I want to say is that many of the technology is also being used by incumbents to make their systems and their services more efficient. Platforms for loan officers or a small POS to get the bank closer to the user, or mobile bank services. So those are the other ones that are used mostly by financial institutions. So basically, that's what it is.
Socorro, that's really exciting. A lot is happening in Peru. I can't resist asking you, in the case of that platform for comparing deposits, you mentioned that when a potential depositor is looking at the various alternatives in the market and sees the different rates, how does the depositor assess the riskiness of the institutions? Do you tell him? Sorry.
Yeah, no, it's we don't tell them. It's their own decision. There is a lot of information, open information, in public information in Peru about financial institutions, about their financial statements and financial indicators, and many other information. There is also a rating system that institutions have that is mandatory, so everybody has to be rated. But as a regulator, we will not recommend a financial institution.
Good answer. Okay, so we've set the stage by talking about some of the more important fintech developments. Some are still very much in the idea stage. Some are actually working. Some are happening. Now I want to move on to the regulatory side of this, which Guy has touched on, and focus on the challenges for regulators that these fintech developments pose, and some of the regulatory steps that are being taken to address those challenges. So I'm going to start with Dirk. Dirk, you co-authored an important paper which outlined a framework within which regulators must decide how to balance the achievement of their regulatory objectives with the need for innovation. Please tell us more about this framework, including 4 possible approaches regulators can take, and also what you've termed the 4 pillars of smart regulation. And if time permits, your comments on how a regulator in a developing country might introduce smart regulation in her or his country would be appreciated too.
Yeah, thanks, John. The first, what we have to realize is that innovation is not good per se. Innovation brings opportunities, but also challenges. Think of the combustion engine, yeah, which is great in terms of speed, but brings with it risks for the environment. And the same is true for financial innovation. Financial innovation can be extremely useful, for instance, for risk sharing, for channeling monies faster around the globe where they are needed. But they can also be extremely risky. Think of certain derivatives. Yeah? So there's a gentleman, not me, who has framed derivatives weapons of financial mass destruction because they have the ability to put risks where they are unexpected due to the connectivity of many financial institutions they create. So we have a certain triangle of interest that we need to consider. On the one hand, we want to have openness to innovation. On the other hand, we need to protect the financial system as such so that it can work. And on the third dimension, we have to protect the clients. Yeah? They are the consumers, they are the investors, but the depositors, whoever is that. Yeah? So the 3 types of different dimensions are in an inherent tension. The easiest way to make sure that no risks ever realizes is simply to shut down the financial system. That's absolute protection. But in a way, it is also an entirely stupid approach because we would take away the benefits of the financial system. Yeah? But just to make sure that whenever we allow for financial intermediation, for financial services, we accept a certain degree of risk. And balancing these risks with the pro-innovation necessity that in particular technology brings about, that is a challenge that regulators have to meet every day. So something like a riskless financial system is like a not existing financial system. And once you've realized that, you understand the huge challenge that we're facing right now in an environment of rapid innovation. The more innovation you have, the more of these challenges are on the side of the regulators. Because right now, they are facing a lot of ideas and a lot of proposals and have to assess them all. They have to understand what comes next. If I allow this technology, how will this technology fit into the services that I have? Yeah? So think about the example from Kenya with this kind of phone card agent banking, which M-Pesa is doing. Yeah? What they do there is they put money to an agent, the agent gives the money to the network provider, and all of a sudden people can bank. Isn't that wonderful? Yes, maybe, unless the agents are unfaithful or the network provider is unfaithful. Both things we have seen in the past. Yeah? Because wherever there's opportunity, there will be fraud and crime. Yeah? So knowing that basically financial services are equally corruptive as they are useful, we have to see it as an overall challenge. And what can we do when we face innovation? First, we can stick to non-legal means, like we speak with people. Yeah? And the easiest way to do that is set up an innovation hub. Luxembourg was the first worldwide country that did that in 2013 already. It founded a department for innovation, and the sole purpose of that was just speak to the people. The sole thing is they had regular meetings with entrepreneurs, and that worked fairly well for this country. But there are also legal means that you can follow. And these legal means are, first of all, you simply do nothing. You just wait which innovation is good enough that someone else has the money to finance it and to pay for the lawyers that kind of make the case in front of you and see whether and how they fit into the existing regulatory regime. Doing nothing is one approach that's possible. Maybe not the best one for all innovations, but for some it is one approach. The next approach is you can abolish regulation. If you remember that the current US president was quite bullish about abolishing regulation, I, as a financial lawyer, I'm a bit frightened by the idea that we abolish certain parts of regulation because most of them had a purpose in the past. You know, they were developed after we had some issues, and usually they address certain issues. Maybe not all of them are warranted, maybe not all of them need to be so expansive, but the principles behind them are usually sound. And the key principle is, how do we achieve honesty in an environment where the financial intermediaries have all the incentives to steal? That's a very, very big challenge in life, and it exists since human beings existed, and it has never changed. So the third approach is a kind of test and learn environment where the regulator is willing to listen to the entrepreneurs and setting up a kind of limited testing period without really connecting this type of test and learn approach to the existing financial system. And the fourth one is what you will probably know as regulatory sandbox. This is a kind of limited license, limited either in terms of scope or in terms of time or in terms of volume, somehow limited license so that you can connect to the existing financial system and provide your services in that regard. So 4 different approaches, and all of them have their ups and downs. When you start thinking about the sandbox, which is probably the most hyped of today, it has some risks and it has some benefits. Let me start with the benefits. The benefits is pretty obvious. You can overcome the tardiness of legislature. If you have a problem to convince your parliament to change the law, and the law is simply prohibiting you to do something, then you can grant a kind of a sandbox regime. That means we just disregard the law for a period of time, and in this case, you don't need approval by Parliament for each and every change. You just need approval for a sandbox approach, which is maybe much easier to argue because it sounds so great. The next aspect is, of course, that when you have a sandbox, you have given the signal we are willing to listen to the innovator and we are willing to talk to you. In particular, in countries where the legislator and the regulator are distinct from the entrepreneurs, this may be a valuable signal. In markets where you have already a very close connection to the finance sector, usually that's not so important. But as a signal also to new entrepreneurs, please come to us, we will listen to you, that can be fruitful. But now let's look quickly at the downsides, and the most important downside is that the sandbox is in a way corruptive to your existing legislation. How do you justify that one firm doesn't have to follow certain rules, but all the others have to follow it? So that's kind of unfair competition in it. The next thing is you weaken the rule of law in your administration, in particular in countries where corruption is a large issue. Maybe the sandbox may be also a recipe for furthering corruption, because now you give them, the corrupt bureaucrats, a justification in hand to deviate from the law. You just say, well, we furthered innovation and at the same time my own bank account, you know? So that's a bit of a problem, and this is very hard to tackle because you cannot look into the mind of people when you do something. And so the problem is, how do you achieve regulatory moral when you have a kind of sandbox approach? Next aspect that we see in a sandbox is that you can hardly justify giving up certain criteria in certain cases. For instance, money laundering checks you can never give up. And there are a number of rules which you simply cannot give up, which are still very costly. So in a test and learn environment, for instance, you can give them simply up because you're not connected to the financial system. You can insulate the consequences. But once you're connected to the financial system, there's a limit of what you can actually give up. Having said, I'm a very strong supporter of furthering innovation, but I'm much more a fan of a so-called innovation hub. This is a non-legal means. Just talk to people, let each other learn about each other, make sure that the learning curve of regulators, entrepreneurs is rapidly going up. and be very careful about legal means unless you're very sure that you have an antiquated system, so certain writing requirements or certain formalities. This is something where you can be generous. Yeah? But usually substantive regulation, like, for instance, the duty requirement to act faithfully with the best interest of your clients in your mind, these core principles should never be touched by a sandbox.
Dirk, thank you. I think that triangle is a helpful way of thinking about the challenges faced by the regulator. Giaz, in several of your papers, you've talked about the risks of leveraging fintech to enhance financial inclusion and the challenges those risks create for regulators. Please describe the most important risks and tell us how regulators are or should be dealing with them.
Thanks, John. Just wanted to ask a quick question before I respond to John. So how many of us have a Facebook account here? So how many of us have not changed the Facebook account password in the last 3 years? Don't raise your hands, please. Just and how many of us have a Yahoo account? Yahoo? Yeah. So you know where I'm coming. So they have all been breached, and the consequences are there to see. There is a MIT paper that says that whatever can go wrong will go wrong faster and bigger when computers are involved. So that's the age that we are living in. And with that as a context, from a financial services point of view, it has profound implications from a policy regulatory standpoint. On one side, we have technology-based business model innovations that are growing rapidly. And on the other side, we have regulatory frameworks that are old, ancient, if I may say, and inflexible. And I see Ma'am Socorro laughing. I have the privilege of not having many regulators in the audience, so please allow me to make that remark. So on one side, we have technology models evolving fast, and on the other side, we have regulatory frameworks that are ancient. You know, just to give you a context, Alibaba in 2017, November 11, they did 257,000 transactions per second. Visa does around 25 to 30,000 transactions per second, you know. So that's the scale and rapidity of innovations that we are talking about. On the other side, India has an Indian Telegraph Act, which was enacted in 1885. And it still is applicable for all wired, wireless telecommunications, data communications. This legislation is applicable. It was enacted in 1885. And of course, India got independence in 1947. So just to give you a context of technology and regulatory frameworks, actually. And it's a wake-up call for us regulators, actually. Because it has 3 major risks. There are many, but 3 major risks, actually. First is on data protection. So we are talking about data-driven financial services, you know, apart from the conventional means of offering financial services, we are leveraging financial and non-financial data to build algorithms, to build credit assessments models, so on and so forth. So there are data ownership, data usage, data privacy implications to these, actually. So, I mean, Facebook probably knows more about me than my wife. So that's the kind of implication that data has on our lives, actually. So it's very important to have frameworks, regulatory frameworks around data ownership, privacy and usage. That's the first thing. Second is on money laundering and terrorist financing, actually. Yeah, there are implications on money laundering, terrorist financing. There is a lot of evidence building up, but two examples to provide here. For example, Bangladesh. Kenya is not the biggest market for mobile money now. It's the Kenya story is good, but Bangladesh has taken over Kenya in terms of the number of accounts, the usage of digital financial services, so on and so forth. And Kenya, and in Bangladesh, we have seen money laundering happening. So if a Bangladeshi worker, for example, is working in Singapore, and he wants to send money to Bangladesh, he doesn't need to open an account. He goes to a Bcash agent in Singapore and gives money, and the Bcash agent calls his friend in the village and asks him to send the money to the residents. So there is a over-the-counter transaction happening without the mapping of the sender and receiver, and this is happening cross-border. So there is actual money laundering happening, actually. And the little said about Bitcoin and ICOs and all those things, the better, actually. So we've seen most of the malware attacks that are happening, the ransom for that is taken in the form of Bitcoin and other cryptocurrencies. So there's a lot of laundering happening on that front also. Finally, cybersecurity. Cybersecurity aspects of financial systems could possibly pose threat not only to the financial stability, but also we have seen the threat it poses to political stability. We have seen that in the US, we have seen that in the Europe. With all things digital, there's utmost importance, impending requirement for regulators to come up with cybersecurity frameworks, actually. And this, when we talk about technology risk, cybersecurity risk, the biggest risk here is not technology. The biggest risk here is still humans. Because humans are the means through which the technology is being leveraged to commit a fraud. Simple low-hanging fruits such as capacity building within the regulatory community, within the financial services community is really very important to manage this risk, actually. I'll take a pause here and over to you, John. Thanks.
Yes, thank you very much. Very, very pertinent points. I'm going to turn to Matthew now. Matthew, from your experience and CGAP's work, what are the basic regulatory enablers that need to be in place for digital financial inclusion to thrive, and how does this relate to microfinance? I'd also welcome your thoughts on the importance of regulatory sandboxes and whether these have a role amongst the basic enablers.
Thank you very much. So I'll start with the end just to sort of get that out of the way, because I think that Dirk already shared a lot of very useful information and perspectives on sandboxes. But I would just echo that from CGAP's perspective, it's something that we've been following, and we do think that there's potential, but it's important to think of regulatory sandboxes within a broader framework of ways that regulators can respond to and help foster innovation. And so some of the benefits are that it does create an open dialogue between regulators and market players, including these new challengers. But it's not the only way to have that dialogue. There are other options that regulators can take. There are benefits in that it can address regulatory uncertainty quickly, which can be an issue for providers who are experimenting with new delivery channels. But again, there are other options, including a test and learn approach, a wait and see, and potentially just changing regulations that are currently outdated, and maybe it's not necessary to go through the process of doing a sandbox. But to step back in terms of the basic enablers, I'll just frame there's a framework that CCAP has also been working on, which is very similar to the triangle that Dirk described, and it's called the ISIP approach. And so we've thought about the objectives that financial regulators work towards. And if you think about them, there's stability, so micro and macro, this is prudential concerns. There's the integrity, which is about keeping the financial system, as free as possible of dirty money, and that's whether that's money laundering or terrorism financing. And then consumer protection. They want to make sure that market conduct that the market players are behaving well and that customers are being treated fairly. And then on top of those three kind of classic traditional regulatory objectives, regulators around the world are also trying to focus on inclusion. And so we think that if you combine these different objectives, there are potential synergies, and then there are also trade-offs. And we think it's important for regulators to be thinking about those, recognizing where these objectives can come together and work well, and then when there has to be kind of a balancing act of how to reach them. But in general, we do think that inclusion can actually support each of those goals, even though traditionally regulators might see inclusion as undermining them. So one of the main messages we've tried to get across is that, in fact, inclusion can work alongside and reinforce those objectives that you already have. So in terms of the basic regulatory enablers for digital financial inclusion, we've broken this down into 4 categories. And so the first is around non-bank e-money issuers. And so in our key, in the geographies where we work, traditionally the banking sector is not a big contributor to financial inclusion for low-income customers. And we think that e-money regulation gives an opportunity for non-banks to serve that segment. And so an e-money issuing license allows you to provide a store of value and a means of payment, but it doesn't allow you to intermediate those funds. So the idea here is that it's a much lower risk activity, which means that the regulator doesn't have to expend as many resources supervising you as they would if you were doing actual intermediation. Then there's the question of agent regulation, enabling providers to serve customers who are in remote areas. And this solves one of the large distribution challenges in areas that are historically very unprofitable. And so ideally, these agent regulations would allow both incumbents and new challengers to use agents. So it could be banks or it could be e-money issuers or other types of fintechs. But the point is that the disaggregating the value chain so that it's not one entity that has to both hold the funds and be the customer-facing and build out that network. We think that it has a lot of potential, and we've seen that in many markets. Then, of course, consumer protection. This is we see this as part of the enabling regulatory environment, beyond just being something that's really important and critical for to protect customers, especially low-income customers who are more vulnerable. But we actually see it as part of the enabling regulation, and we see this because it comes down to the question of trust, around building trust and making sure that customers who don't have a lot of experience with the financial sector and are vulnerable are able to participate with confidence and without jeopardizing their financial well-being. And so if we think about, I'm sure a lot of people in the room have credit cards, and would we be as inclined to use our credit cards if there was no regulatory framework that protected us from fraud or from, bad things happening to us but because of what the provider is doing. And then finally is the what we call proportional AML-CFT regulation. And so this is related to what Dirk was talking about with eKYC. And so there are kind of two ways to approach this. One is to increase the availability of IDs, which we're seeing in a lot of countries who are focusing on this base ID. And then the idea is that, well, if everyone has that state-issued ID, then that solves the barrier between them and the providers, because they get turned away because they don't have the proper identification. But in fact, there's more flexibility at the standard-setting level from FATF, the Financial Action Task Force, which is the global standard-setting body for financial integrity rules. There's actually more flexibility that in-country regulators can work with to make sure that they are both in line with the standards that are set, but also not creating unnecessary barriers so that people are excluded from the financial system. And so the idea here is that, in fact, from the perspective of a financial integrity regulator, you would think that, well, we don't want to let people into the system if we don't know enough about them, because that will harm the integrity of our financial sector. But in fact, one of the arguments that has really gained a lot of traction is that, in fact, financial exclusion is an integrity risk, because the more that people are operating outside of the financial system, you have no eyes on what's happening. So the more cash transactions that are in your economy, it actually decreases your ability to spot both money laundering and terrorism financing. And so we think that's a really important step that FATF has embraced and has published on. And now it's a question of, at the country level, those regulators accepting that, in fact, we don't have to work so hard to exclude these people from entering the financial system, but there's really a balancing act. And in some countries have gone very far with that, like in Mexico, which now even has a tiered KYC system that includes an anonymous base account, where you are, the balances and the transfer amounts are very low because they recognize that the ID requirements are very low because the account has these restrictions on it that are lowering the risk to such an extent that the identification requirements are no longer that important.
Makes good sense. Thank you, Matthew. Now, Socorro. I'm giving you the last word again because you're actually doing this stuff. And I know the rapid pace of change in the fintech sector is creating some big challenges for you in Peru. Please talk about the challenges you're facing and what you're doing about them.
Okay. Well, if you are, you have heard the members of the panel, by now you're sure that this is a very interesting time and very hectic time to be a regulator. And so one of the things the challenges that the regulator has is to understand the models that are there, to understand which ones need regulation, what needs to be regulation, and why do they need regulation. So there are many things going on, and some of them require very little regulation from a prudential point of view, or from a money laundering point of view, and so the different, that needs a lot of time, takes a lot of time, just understanding takes a lot of time for the regulator. We have a permanent small team of people understanding or analyzing permanently all these different types of models to understand what needs to be regulated, what we do first, what is more urgent for the country, what has to be done now, what can wait. So that is the first decision that needs to be taken. Well, the types of regulation that you need have already been mentioned at length. You have to regulate for financial stability purpose or prudential purposes. You have to regulate for consumer protection purposes to prevent fraud or bad market conduct problems or data security issues or data protection issues. And you have to also regulate for financial integrity issues related to anti-money laundering things. So those are the main regulatory things. And some of the business models need one of those types but not the other ones. And some of them need all of them at the same time. So the decisions need to be made at the policy level. What do you regulate, for what reasons, when? That's the main area of concern. The second area of concern for regulators has to do with proportionality, regulatory arbitrage, level playing field. Because while you want to promote and facilitate innovation, you do not want to create opportunities for regulatory arbitrage, whereas there are holes that are used by people or businesses that are trying to avoid the main framework of regulation. So you have, but at the same time, you want to use proportionality, you want to facilitate, you want to use, for small startup businesses, you want to use a very light environment of regulation to encourage innovation. So there is a big balancing act. And the third group of things that we have to think is, well, what legal obstacles need to be removed in order to promote this innovation? Do we have to eliminate some of the barriers, some of the laws, some of the regulations? And of course, when you do that, you have to take all the safety precautions that what you are doing does not hamper other main policy objectives of the financial system. So those are the main issues, and now I want to talk about how are we dealing with those. First, well, as I said, we have a permanent group of people analyzing all these issues and giving us policy advice and designing a strategy. Some of the things that are some of the fintech models or some of the models, business models, do not need any special regulation or can be handled with the regulation that is already in place. So just in those cases, well, do nothing, basically. We already have a regulation that allows e-money issuers to operate that we introduced 5 years ago. So that's why e-money can be issued in Peru. We already have an ample and a broad range of operational risk and information security risk regulation that takes care of several of the information technology risk, data protection issues, although we are also working on a new version that is more specific for cybersecurity risks. So, but the main framework is already been there, been approved. Then, what do we have in progress? We have a crowdfunding law or draft law that is being sent to Congress, that is already been drafted. And our approach basically regulates different types of crowdfunding and makes a separation between the business models that operate by taking money from a person and allocating it directly to some loan or credit decision, where the person takes the decision of where the money goes, and basically the money is channeled directly from one place to the other. So that's one possibility. And for that, we call, well, there is an investor risk, and it's going to be regulated by the securities regulator. There is no deposit there. There is just an investment. The money goes from here to here. The person putting the money knows where the money goes. So that's one type of model, and it will be regulated as a securities company. Then there is another business model that is a more bank-like business model, where the people puts the money here, there is a platform in the middle, there is some algorithm in the middle, and the money goes to some cloudy place, a group of, so that is more like a bank. And for that, we will require to go through the superintendency of banks and get a bank license. So so there are two different big groups. You know? So that's the crowdfunding law. And of course has anti-money laundering requirements and data protection requirements and also all sorts of other issues. It has been worked together by the central bank, the superintendency of banks, the security regulator, and the Ministry of Finance, all of us together working in the draft law that is going to Congress. So that's one of the things that are in progress. The next thing that is in progress is, as I said, the cybersecurity regulation, cloud computing regulation, and also Sandbox regulation. We already issued a small one that has to do with pension, on sandboxes, that has to do with pension funds. And there is a pension fund that wants to do a partnership with gas stations. In Peru, we have a problem for people saving long-term and putting money into their pension funds. They don't want to do it, and especially since we have a large informal economy, all those who are informal or are independent do not contribute to pension funds. So what this pension fund company administrator wants to do is to have a small platform at the gas station with the partner gas stations where the people, when they go buy gas, especially for taxi cabs, it's useful. When they go buy gas, they say, well, I don't know, 1% of my gas bill goes to my pension fund. And the gas station will provide a discount for the gas so that the money goes to the pension fund. So, and the discount will be paid by the pension fund. So we don't know if it's going to work, but we have already established a regulation, a framework for that, and we're hopeful that at least the taxi drivers are going to use it to put money into, voluntarily put money into their pension funds. Then future things that we have not done yet and that need to be done. Digital assets, and that's a huge issue for regulators because this is a global thing. And being able to, how do you regulate platforms that operate at global levels and that require, well, there are jurisdictional issues to identify who is doing what. And then the last thing that we need to do is work on a digital identity to allow digital contracts. And we need, that also a legislation that needs to be drafted and that we're working on. So those are the issues we have.
You have a very full plate, I can tell. Now, I've actually got a third round of questions, but I'm going to hold those because I want to allow time for questions from the floor. So we'll see. If there are no questions, I'll go to the third round of my questions. But otherwise, I would prefer to take your questions. So the floor is open. Yes.
Can someone pass a microphone to the gentleman, please?
Damn it. There's a mic here, I think. Yeah. Yeah.
Thank you. I'm Edward Source from the Grameen Credit Agricole Foundation. We are investing in MFIs, providing debts mostly. And we are registered in Luxembourg, so we have to comply with the regulation here. And as you know, there has been some, at least in the banking sector, some sanctions for actors who have not complied with the law. But on the other side, in the countries where we operate, the regulation, especially in terms of KYC, AML, CFT, is not always very much developed. And so I just wanted to ask one question to have an idea of the development of the regulations in the different countries where there is financial inclusion, is how many countries have developed simplified KYC, AML, CFT rules to help MFIs do financial inclusion while complying with the regulation in terms of AML, CFT.
Dirk, do you want to try that, or you're going to, Giaz, you're going to take that?
Well, thank you. I can take that, yeah. Thank you for your question. I don't have a number off the cuff, so probably, I mean, I can get back to you with the exact number, but probably around 25, 30 countries have done that. But what is more important to know here is, even if the central bank allows a simplified KYC regime or a tiered KYC regime, the financial sector players are not willing to implement it for the fear of the fines, the increase in the compliance costs. This is something that we have seen across all the jurisdictions, actually. So even if a MFI, for example, is operating and it has to have a banking relationship, so the banks would probably not encourage a MFI that is opening accounts through simplified KYC rules, actually. So the banks are not, the main financial services players are not willing to go easy, even if the regulator provides that leeway, actually. So that's been our experience. Thank you.
And then Socorro.
Just one thing. The important part is the FTAF rules give flexibility. National regulators can give that further to their participants. And very often then the question comes, what can I do on the ground as bank? And the simple answer would be we do nothing. That's probably not enough. And you have two ways to do KYC checks, ex ante or ex post. And most people have yet applied ex ante, but ex post is much more powerful when you think of big data applications. Of course, this sounds now very sophisticated, but very often it's not so sophisticated. But very often being afraid of something prevents you from doing it in the beginning. Yeah? And you don't want to be the first one. You don't want to be the guinea pig. You want someone else to have someone else's head on the block. You know? So.
Just short, we do have some simplified KYC. Or no KYC for instance, for electronic money, for the BEAM account users. Basically, there's no KYC, but the amounts that can be transferred through that system are kind of small. So we control that by the size of the transfers. But we share the experience that G has mentioned. We have a similar account system, simplified account system with KYC simplified version of it. And we have the same problem. The banks do not use it. So we approved the regulation about 5-6 years ago. And so far, only one bank and one microfinance institution are using it. And it's not very intensively used. So the obstacles are not regulatory, or they're others.
It's just to sanction what happens if you're wrong. That's the point. Yeah.
Other questions? Yes.
So far, you have mentioned two of the main animals in the fintech world. Startups, non-financial entrepreneurs that came up with an idea and launched it, and the introduction of innovation by incumbent banks. First ones probably could have a positive impact on financial inclusion. I doubt regarding the second one. But you haven't mentioned the third model, besides a brief mention of Facebook, that is the incursion of these huge technology conglomerates into financial activities, and I'm referring mostly to the two Chinese giants, Ant Financial and Tencent, that are offering their clients, most of them without prior experience in the financial system, with the first access to financial accounts and the whole range: payments, banking, insurance, and capital markets. What will you be your opinion on the capabilities of the local regulators in emerging markets when those giants start to showing up? I understand that Ant Financial is now in India and also Indonesia. Given the difficulties that regulators in advanced economies such as Europe and the US have had with these technology groups?
That's a great question. Who wants to try that? Dirk?
Of course, the advent of tech fins, how we call them, are a game changer here. But in terms of the pure financial inclusion perspective, I think the balance is by and large positive. Of course, a regulator of a small country has difficulties, but India is far from being a small country. Yeah? So my point is just here, as I said, innovation is risky, and tech fins bring about a new type of risk. And probably the type of risk that they are creating, the connectivity, in particular around the globe, is more of a systemic perspective. But I can assure you that the Financial Stability Board, as a main systemic regulator, has been made aware of these issues, and they're addressing that.
Just to complement, thank you for making such a important point, actually. One, that's why definitely regulators are terrified, and the scale at which the tech fins are growing is an issue of botherance. That's why most of our members, they want to learn from developed countries. So they want to see what, for example, Europe is doing, what UK is doing, what Singapore is doing, and learn from those experiences and contextualize to their own jurisdictions. For example, just to give you one quick example, in Singapore, the regulations are slightly different. If you're a financial institution, there is no one banking license that you have to take. You have the licenses are product-based. So if you want to offer insurance, there is an insurance license. If you want to offer credit, a credit license. So it's more a functional product-based approach to regulation, and as a it's of course looking at it could be inefficient, but we see that the technology-based financial services are slicing the financial sector as a whole. And as one response to that is also financial supervisors and regulators taking a product or a functional approach to regulation, actually. And Singapore is doing that already.
Okay. Those nice ladies at the back of the room seem determined to bring this thing to a close. I have a feeling we could deal with a lot more questions because this is a very interesting topic, but we will have to end it. I think you can see that the regulation of fintech and financial inclusion is a really important subject. It poses big challenges, and but you can see that there are also some creative solutions, and you can also see that the one regulator on the panel is certainly not following the first two pillars of Dirk's model, shutting down the financial system or doing nothing. Socorro, you're being very proactive in addressing the challenges of fintech, and your other panelists have got lots of ideas for additional things that you and other regulators can be doing. So this is going to be keeping regulators busier and busier, but it's very important that regulators be as proactive Socorro and try to stay ahead of the curve, because regulators really do want to foster these developments as well as dealing with the dangers and the risks. So I'd like you to join me, please, in...
the bus for the European Microfinance Awards are leaving in the ground floor.
That's the end.
No, it's not. We are
That's
going to
strict
thank
enforcement.
the panelists, please. And thank you all very much for being such an attentive audience.